At this point, I'll introduce our two experts that will be presenting and answering questions today. We have Melody Bunting, the Training and Career Development Manager at Wegner CPAs, and Kate Serpy, a Senior Manager in our Accounting Solutions Group. Kate, I'll turn things over to you.
Great, thank you, Kristen. And thank you to everybody that's joining us today. I know that this has been much anticipated for organizations that are going to be eligible to apply for the Restaurant Revitalization Fund. So we've gotten some more information from the SBA over the last few weeks about this program. So we're going to dive into some of those details here. So first things first, just a little bit of background. The Restaurant Revitalization Fund, which I'll probably refer to as RRF throughout this program, was established as part of the American Rescue Plan Act, which was signed into law on March 11th of this year. That's where the program was actually created. It's available to restaurants and other similar eligible businesses, which we'll talk about in more detail. And there's about $28.6 billion in funding available. Right now, it's important to note that there is no official start date yet for the application portal to be open, although it is anticipated that it should be sometime in the next few weeks now that all of this information has been released. There are some quote unquote set asides from that $28.6 billion that will be available to specific applicants. $5 billion is set aside for applicants that have 2019 gross receipts of $500,000 or less. $4 billion is set aside for applicants with 2019 gross receipts between $500,000 and $1.5 million. And then $500 million is set aside for applicants that had 2019 gross receipts of not more than $50,000. You'll notice a number of words that we're going to be using, and I promise I will define those in more detail as we continue through the presentation. One of those is certainly gross receipts. That's been a hot topic with all of the different lending and grant and credits that have come out through all the various stimulus packages. So we'll talk a little bit more about what that means specifically for RRF. So eligibility requirements for this program, they are kind of what you would think they are for the Restaurant Revitalization Fund. You have to be a restaurant, food stand, food truck, or food cart. You can be a caterer and apply for this program. Those that own bars, saloons, lounges, taverns, snack and non-alcoholic beverage bars, so like a coffee shop. And then other entities, although I have highlighted in red here that there is an additional requirement for these entities, bakeries, brew pubs, tasting rooms, tap rooms, breweries, wineries, distilleries, and inns will need to prove additional eligibility related to their on-site sales to the public. They must comprise at least 33% of gross receipts. So we'll talk a little bit more about that as we continue through. But essentially right now, all of these types of entities will be eligible for the Restaurant Revitalization Fund. Other eligibility requirements include the fact that you either need to be open right now, only temporarily closed, or opening soon with expenses incurred as of March 11th, 2021. That opening soon with expenses incurred as of March 11, 2021 is great news for those organizations that maybe haven't actually ever opened their doors for business. There were certainly a lot of entities across the country that likely had big plans to open in the year 2020. And then of course the pandemic hit and some of those plans got set aside just due to the nature of trying to open a restaurant during a global pandemic. But what's great about this program is that if you had eligible expenses that were incurred as of March 11th of this year, even if you didn't have any sales, you will actually be eligible for this program as long as you meet a few other requirements. So keep that in mind. I've had answered a number of questions already from people that are in that exact position. Either they opened their doors after February 2020, maybe in the summer of last year or in the fall when things started to open up a bit more, or they haven't opened yet. And great news for this program is you are eligible. And additional eligibility requirements include the number of locations that are owned. So as of March 13th last year, You owned and operated together with affiliates 20 or fewer locations. So a reminder about affiliates. Affiliates typically have ownership in common or some sort of direct control of the business in common. Ownership is typically 50% or more ownership. The direct control is typically somebody charged with management, somebody charged with the direction of the business is going to be somebody that's kind of in control of the organization. And affiliates aren't necessarily multiple locations of the same restaurant. One owner may own 3 different kinds of restaurants. Perhaps they own a food truck and they own a sit-down restaurant, and maybe they also own a coffee shop. They may not have the same name, but if they have the same owner, they are considered affiliates. So you have to have 20 or fewer locations to be eligible for this grant program. You also must be able to make the good faith certification that current economic uncertainty makes the funding request necessary. This certification has been pretty standard across all of the lending and grant programs since the CARES Act of last year. So you'll see a similar certification part of the PPP program. If you applied for an economic injury disaster loan, that was another certification as part of that program. If you were looking into the shuttered venue operator grant, same certification. So that certification has kind of been standard across the board for all of the funding that's been produced from the different stimulus bills over this last year. So organizations that are ineligible, these are pretty specific, and the nonprofit organizations is actually the first item I've listed here. This is something that we didn't know about until the guidance came out now. So if you are a nonprofit organization, know that you are not eligible for this grant program. You are still eligible for things like the Shuttered Venue Operator Grant and PPP funds, but specifically for the Restaurant Revitalization Fund, nonprofit organizations of any kind are not eligible. Publicly traded corporations are not eligible. If your organization received a shuttered venue operator grant, or if you have applied for a shuttered venue operator grant. So that program finally opened up yesterday. If you intend to apply and you've submitted an application for that program, you won't be eligible unless you are actually denied a shuttered venue operator grant, but you won't be able to apply for RRF until you have been officially declined an SVOG grant. Again, back to that owning or operating more than 20 locations, that would make you ineligible. Again, it does not need to be 20 of the same restaurant or 20 of the same food truck. It is 20 locations that they are together with your affiliates, which we just talked about. You're also ineligible if your business has permanently closed. So if you have shut your doors, even if you had incurred expenses, let's say you shut your doors as of March 1st of this year, if you are considered permanently closed, you will not be able to apply for this grant. If you filed for bankruptcy, either if you filed for Chapter 7 bankruptcy, you are not eligible at all. If you filed for Chapter 11, 12, or 13 bankruptcy and you are not operating, so you aren't restructured and operating under those bankruptcy chapters, you are not able to apply for this grant. And then finally, state or local government businesses are not eligible to apply for RRF. So what do you get with this award? The maximum grant award is $5 million per location. Again, we're going back to the location is designated by together with their affiliates. So those that are owned and operated by a majority control group of equity owners, or if they're managed by the same group of people that have direct control over the direction of the business. So it's $5 million per location. Maximum of $10 million in total for applicant and any affiliates. So all of your affiliates can't get more than $10 million in total grant awards from this program. The minimum funding request is $1,000. So for example, if you Do your calculation, which we'll go into the details on calculating in a second. But if you do your calculation and your grant award would be $500, you are not eligible for this program. Once you do the calculation for your funding, the minimum amount is $1,000. So it doesn't mean that if you do your calculation and it's less than 1,000, that you'll get $1,000. It means that when you do your calculation, it must be at least $1,000 and then you're eligible for the program. You also cannot apply for a PPP loan after applying for RRF funds. If you have received a PPP loan already in 2021, either a first draw or a second draw, that's fine, that you are still eligible for the Restaurant Revitalization Fund. As we'll talk about in a second, the PPP loans that you have received either in 2020 or 2021 are going to be deducted from your maximum grant award amount. So this is just saying that you cannot apply for a PPP loan after you have already applied for the Restaurant Revitalization Fund grant. So now we're going to go through a couple of ways to calculate the grant amount. Melody, I just want to make sure before we go into this that there aren't any questions that we should address before we move forward.
Just a simple one. If a restaurant has gross receipts more than 1.5 million, are they eligible?
They are eligible. Yep. So there isn't actually a gross receipts maximum requirement or minimum requirement. The way that you calculate your gross receipts, we'll talk about that in a bit, but the way that you calculate your grant amount is going to just be based off of those gross receipts. You have to be considered a small business, again, similar to all of the other programs. So if you have more than 500 employees, you aren't considered a small business based on the SBA's guidance about what a small business is. So you may not be eligible for this program, but there technically is not a gross receipts maximum that would make you ineligible. There are just specific funding, what they call set asides for those that have different amounts that have lower gross receipts than others. So what I talked about in a slide earlier regarding those set asides, there was $5 billion set aside for organizations that have $500,000 or less in gross receipts, $4 billion set aside for those that have 500,000 to $1.5 million in gross receipts, and then 500 million set aside for those with 50,000 in gross receipts or less. So that's 9.5 billion of the 28.6 billion in total that has been allocated to this program. So whatever 28.6 minus 9.5, about 17 or so billion dollars is allocated for anybody that's got greater than $1.5 million in gross receipts in 2019. So there'll be a good chunk of money that's allocated to those restaurants that have higher gross receipts. All right, so let's go ahead and dive into the calculations. So there are actually 3 different ways to calculate the grant amount, and they're going to be based on when you started your operations. So what the SBA considers in operations is when you were actually making sales. So calculation 1 is going to be for any applicants that were in operation, again, making sales prior to January 1st, 2019. So this means you've been in operation since 2018 or earlier. You're going to take your 2019 gross receipts, and again, we're going to dive deeper into gross receipts in a bit. 2019 gross receipts from your tax return, your 2019 tax return. You're going to subtract your 2020 gross receipts from either the tax return that you've already filed or the tax return that you intend to file. Many 2020 tax returns may be on extension right now. If you file a Schedule C on your 1040 as a sole proprietor, that due date is actually May 17th. So you may not have filed at this point, but you want to make sure that whatever number you report as your 2020 gross receipts matches what you intend to file on your 2020 tax return, because those tax returns are going to be used to reconcile what you've reported. So subtract your 2020 gross receipts. You're going to be excluding PPP loan forgiveness, The SBA Section 1112 payments, those are the payments that the SBA made for borrowers that already had a 7A or a 504 loan from the SBA. So those are the traditional small business loans that organizations can receive from the SBA. Part of the CARES Act was that the SBA, the government would make payments for 6 months on behalf of those borrowers. And that's what a Section 1112 payment is. EIDL advances, FRRP appropriation, which is the Randolph-Shepard Act financial relief and restoration payments, and then any state and local small business grants will be excluded from your 2020 gross receipts. So those will not be included. And then you subtract your aggregate PPP loans received. So that's a PPP loan received in 2020 and any loans received in 2021. The max is 5 million and the minimum is 1,000. Again, if the requested amount is less than $1,000, you are not eligible for this grant. So it's pretty straightforward calculation. 2019 gross receipts minus 2020 gross receipts minus any PPP loans received. So if your 2019 gross receipts were $500,000, your 2020 gross receipts were $200,000, you're at $300,000. And then if you got total PPP loans of $100,000, you're going to take $500,000 minus $200,000 minus $100,000, and you're going to end up with a $200,000 RRF grant. So again, it can be quite lucrative, especially if you saw a substantial dip in your gross receipts from 2019 to 2020. Just remember that you will need to subtract out the aggregate of any PPP loans received. So that's calculation one. That's kind of the most straightforward one. Again, though, that's for applicants that were in operation prior to January 1st of 2019. So what if you began operations in the year 2019? So what you're going to do in that instance is you're going to calculate your annualized gross receipts. So let's say you started a business in June of 2019. You're going to start with your, again, 2019 gross receipts from your tax return. You'll divide the gross receipts by the number of months that you're in operation. So let's say you started your business June 1st. So you were in operation for 7 months of 2019. So you're going to divide your 2019 gross receipts by 7 to get your average monthly gross receipts. And then you're going to multiply that average monthly gross receipts by 12 to get your annualized gross receipts. Then it goes back to essentially the same calculation as the first one. You're going to subtract your 2020 gross receipts, again, excluding those very specific payments, subtract your aggregate PPP loans received. Again, max is 5 million, minimum is 1,000. If a requested amount is less than 1,000, you're not eligible for the grant. Then we have our final calculation. So this is for applicants who began operations in 2020 through March 10th of this year, or if, again, you haven't opened for business yet, but you have incurred eligible expenses as of March 11th, 2021. So let's maybe just talk about that incurred eligible expenses as of March 11th, 2021. Perhaps you've already been paying rent, or maybe you had purchased a building and you have a mortgage on it. You've been paying utilities, even though you haven't been opened yet. You've been stocking up your inventory, so purchasing food and beverages in preparation for being open. As long as you have incurred those eligible expenses as of March 11th of this year, you will be eligible for this grant. So that's great news for those restaurants that were thinking about opening but have pushed. You'll actually be eligible for this as well. So for this calculation, you're going to calculate the total amount spent on eligible expenses incurred between February 15th of last year and March 11th of this year. So about 13 months worth of expenses. You're going to subtract your 2020 and 2021 gross receipts from your tax return, or whatever is going to be reported on your tax returns. So we look at 20 and 21, the question would be, well, what are you using for 2021? So again, if you've been open, you would use any gross receipts that you've received in 2020 or through March 11th of 2021. Those are going to be your gross receipts. Obviously, nobody has filed a 2021 tax return yet, but again, you want to be thinking about what will be reported on the tax return. So any gross receipts that you've incurred to date. You're going to exclude that PPP loan forgiveness and all of those other payments, subtract your PPP loans received. Max is 5 million, minimum is $1,000. So if you don't have any gross receipts yet because you haven't opened, the likelihood is that your maximum grant amount is going to be those eligible expenses that you incurred between February 15th and March 11th of this year, not to exceed $5 million. So don't be concerned if you don't have any gross receipts. Again, they have specified that if you have not opened yet, but have incurred eligible expenses as of March 11th of this year, you are still eligible. So that second line may not apply if you only have eligible expenses and no gross receipts, but you are still eligible for the grant. Any questions, Melody, on the calculations?
Not on the calculations. We've got a couple of specific entity type questions. Do you want those now or you want to wait?
Why don't we wait until the end? We'll go through, maybe we'll get answers to those. All right. So gross receipts, I've said gross receipts probably about 50 times already in this presentation. Like I said at the beginning, it's been a hot topic because gross receipts has pretty much been defined differently for every program that's been made available through the CARES Act, the Economic Aid Act, and the American Rescue Plan Act. So it's very important that we understand what gross receipts mean for each of these programs. So specifically for the Restaurant Revitalization Fund, the documentation states that gross receipts is all revenue from whatever sources. However, it doesn't include certain things. So specifically for restaurants and bars and taverns and organizations that would be eligible for this program, the gross receipts that are included, so when you're looking at your gross receipt calculations, are sales of products and services, any interest and dividends, so think investment income, rents, royalties, fees, and commissions, if you have anything like that. And then I've listed here specifically from the tax return, from your tax returns, which line you're going to be looking at. So that should make it pretty simple when you're looking at 2019 or thinking about 2020. Again, if you haven't filed your 2020 tax return, these are the specific lines that you're going to be looking at. So from the 1040 Schedule C, so that means you're a sole proprietor and you report your income and loss from your business on your personal tax return. You're going to be looking at the Schedule C at line 3. That's going to be your gross receipts total. If you are a partnership and you file a Form 1065, you're going to look at line 1C. Same thing if you're an S corporation or a C corporation. So you file either a Form 1120S or 1120, you're going to be looking at line 1C. Things that are excluded, specifically excluded from gross receipts, are net capital gains and losses, PPP loan forgiveness, as we talked about before, SBA Section 1112 payments. Again, those are the payments from the CARES Act and the Economic Aid Act that were made on behalf of borrowers of 7A or 504 loans from the SBA. Any idle advance money, whether you received an idle advance last year or you were able to receive a targeted idle advance this year, all of that is excluded from gross receipts. If you received any state and local small business grants, so it specifically states whether it was from the federal government passed through state and local, or if you received a state or local small business grant that was not associated with a stimulus bill, all of those would be excluded from gross receipts. Any taxes collected, so think sales tax and remitted back to a taxing authority, that would be excluded from gross receipts since it's just a pass through. And any proceeds between a concern and its domestic or foreign affiliate. So if you have another affiliate and you have loans between the two, any money received from that affiliate is not included in gross receipts. So how can you use these funds? Luckily for the Restaurant Revitalization Fund program, there aren't many restrictions on how you can use these funds. So if your business has received a PPP loan, you'll know that it was fairly restrictive in how you could actually use those funds. What's nice about some of these grant programs is that it's not quite as restrictive, although there are some items that you can't use the funds for. Specifically, what you can use them for are payroll costs, any business mortgage or rent, specifically no prepayments, same with business debt service. So if you had a loan, you are able to use these funds to make payments on those loans. However, you can't use the funds to prepay those loans. You can use it for utilities as long as that service was in place before March 11th of this year. You can use it for maintenance expenses. If you are constructing outdoor seating, you're able to use the funds for those purposes. Any supplies that you need, that's inclusive of PPE, so any protective gear or protective costs if you're installing, shields or in your drive-through, any of those costs are included. Food and beverage costs, obviously inventory, that's all eligible. And then covered supplier costs, which they define as essential to the operations of the business. And it's made pursuant to a contract, order, or PO that was in effect at any time before the receipt of your RRF funds. So covered supplier costs are going to cover most of your contracts that you have with your suppliers. And then operating expenses. So anything that is normal and necessary as part of your day-to-day activities. If you have a legal team that you use on a regular basis, if you use an accountant or a bookkeeper, all of those would be considered normal and necessary. If it's a cost that is not associated with a day-to-day activity, and it's something that doesn't fall into any of the other categories, it would not be an eligible use of funds. But that operating expenses and covered supplier and supplies costs are going to be fairly inclusive of many of the day-to-day operating expenses that you have. So there aren't going to be too many restrictions on how you use the funds. So when can you use the funds? That's a pretty important piece of the puzzle here. Covered period, again, has been, I think words that, or phrases that we didn't really think much about before have been kind of thrown into our lexicon of daily words. So covered period is another one of those. So there is a covered period for when you can use the funds, and there are going to be some reporting requirements. So these funds can be used for any expenses that were incurred between February 15th of last year and March 11th of 2023. So you have quite a while to use these funds. In my example before, where somebody had $500,000 in gross receipts in 2019, they may be looking at $100,000 or $200,000 of grant money. They may not need all of those funds in this year. Maybe they're behind on rent and they need to catch up. Those are all going to be eligible expenses as long as they were incurred. So they happened between February 15th and March 11th of 2023. So almost 2 years from now. If your business permanently closes before March 11th of 2023, your covered period will end as of the date that your business permanently closes. So just know that if this funding doesn't help make it through and your business permanently closes, your covered period will end as of that date. If you have any unused funds, they must be returned to the government. And that kind of leads us into what are the reporting requirements. So all applicants must submit a report not later than the end of this year, so December 31st, 2021, via the application portal. So you will have some instructions as you're going through the application portal. There will be some follow-up that you'll need to submit through that same portal. You're going to have to report how much of the award has been used against each of the eligible use categories. So you're going to want to make sure as you continue forward that you have some sort of good tracking method so that you know which bucket each of those are going to go into. Because you're going to have to report, let's say you received a $200,000 grant, and as of the end of this year, you've used $100,000 of it. You're going to need to report via their portal how much of that $100,000 you've used in each eligible category. If you've used all the funds by the end of this year, again, you'll need to certify that you used all of the proceeds on eligible expenses. If you haven't used all the funds by the end of this year, just know that that same reporting is going to be need to be done on an annual basis. So it's not a one and done at the end of this year. If you've got funds that are carrying over into next year, you're going to need to do additional reporting on at least an annual basis. So just be thinking about that as you're tracking. It's important, of course. You know, we're accountants. We help our clients track their expenses on a regular basis, but it's important to make sure that you've got some sort of tracking system in place so that you can be ready to do this reporting when the time comes. So how do you apply? Again, as a reminder, the portal has not opened yet. So you aren't able, you can go to this restaurants.sba.gov. You'll see a landing page. However, you are not able to apply yet. So just remember, it's not open yet, and you'll have more information once it is open. But there are actually 3 different ways that you'll be able to apply. The first one is through the SBA portal at restaurants.sba.gov. So it's a portal that would be hosted by the SBA. It'll be similar to if you applied for an economic injury disaster loan. There was a portal to apply for that. Same for the shuttered venue operator grant. It's just going to be a portal at sba.gov. Another way that you may be able to apply is through a recognized SBA point of sale or POS restaurant partner. The current partners that they're working with include Toast, Square, and NCR Corporation. They are continuing to look for additional point of sale restaurant partners to hopefully streamline the process for potential applicants that use any of these point of sale systems. There isn't a lot of detail about how these point of sale restaurant partners will work, but the idea is that these POS restaurant partners will have their own portal, and those restaurant partners will be able to pull the POS data for those users. So if you use Toast as your point of sale system, Toast will have a portal on their website that you'll be able to apply through. It will ask for most of the same information. However, your gross receipts will already be populated in the system, in the point of sale system. So it may be a little bit more streamlined to apply if you use one of the POS restaurant partners. Again, they are attempting to get more restaurant partners, but there isn't a lot of detail. If you use one of these, one of the ones that I've listed here, make sure that you're keeping in touch with that point of sale. If you have a contact, make sure you're keeping in touch on their website to make sure that you have any information that's related to their specific portal. And then you can also apply via telephone. If for some reason you don't have access to the internet, there will be a way to apply via telephone. I've listed the phone number here. It is important to note that these applicants will likely have a longer waiting period only due to the fact that the required documents will need to be mailed to the SBA. So that will certainly make the process a little bit longer in terms of when you may get the funding. So if you can, definitely try to apply either via the SBA's portal or one of the point of sale portals, and avoid that the telephone option if possible. So what will you need to apply? You will need some documents. There is the SBA Form 3172, which is the grant application itself. If you haven't been to the sba.gov website, there is a link at the end of this presentation that will take you to the landing page for the SBA's Restaurant Revitalization Fund information. Please make sure that you go to that website and take a look at the Form 3172. That is the actual grant application itself. It's a draft, so there is definitely a possibility that it could change. Things could be added, things could be removed, but it's about a 16-page document. It's fairly straightforward, but it's good to look through it just so that you're prepared and ready to go. You shouldn't need to actually fill out that form that's on the website. The portal itself should walk you through the application. But at least you'll be able to take a look at the grant application itself. It asks questions about ownership, what type of entity you are. It's going to ask about your PPP loans, and then it's going to ask you to calculate what your maximum grant award amount is. So 16 pages sounds like a lot, but there are a few pages of certifications as well. So it's really not too bad, actually, of an application. You'll also need to fill out Form 4506T. What Form 4506T does is it allows the SBA to request tax information from the IRS on your behalf. So even though you will likely be submitting tax returns as part of your documentation, they also want the 4506T so that they can request any other documentation from the IRS if it wasn't initially submitted by you. So there are tutorial videos on the SBA.gov website about filling out the Form 4506T. I highly recommend that you watch those. They are specific to these grant programs on how you will need to fill them out. So please make sure that you're visiting that page. Again, there is a link at the end of this presentation. For your gross receipts documentation, you will need to supply either tax returns. That's going to be the primary way to show those gross receipts numbers. But if for 2020 you haven't filed your tax return yet, you can also use bank statements, either internally or externally prepared financial statements, or your POS point of sale reports, which would include your 1099-K. The 1099-K is the information return that you receive from your credit card processors that lets you know how much you had in sales via credit cards or PayPal, things like that. Applicants that must prove that 33% test. So if you remember back at the beginning, organizations like bakeries, breweries, wineries, distilleries, they have to prove an additional test. They have to prove that they had on-site sales to the public of at least 33% of their total 2019 gross receipts. So you're going to have to prove that via POS reports if it breaks it down by the type of sales that you had, or you're going to have some sort of internally or externally prepared either financial statement, management report, something that proves that your on-site sales to the public comprised at least 33% of your 2019 gross receipts. So when you're thinking about that, you may ask, what other types of sales might those organizations have? Things like bakery or a brewery may have wholesale sales, so they may be selling to a distributor. Or they may be selling maybe to a grocery store. So those would not be considered on-site sales to the public. Those, on-site sales to the public would be people are coming into your brewery, people are coming into your bakery, they're purchasing something either to go or they're purchasing something to sit in the restaurant and eat it there. So you're going to need to figure out, if you fall into one of those categories, a way to break out those gross receipts. For INs specifically, they are eligible, but they do have to provide evidence that on-site food and beverage sales to the public comprise at least 33% of their 2019 gross receipts. Obviously, with an inn, they may have lodging income, they may have event income, so they need to provide evidence that specifically their food and beverage sales to the public comprise at least 33% of their 2019 gross receipts. So what about the timing? As I've noted a couple of times, but want to say it again, just to make sure everybody is clear, the application portal is not yet open. We expect it to open sometime in May. And there is actually a priority period. So once the portal opens, days 1 through 21, so the first 3 weeks of the portal being open, they will be accepting applications from anybody that is eligible to apply. However, they will only be distributing funds to applicants who have self-certified that they are majority owned by women, veterans, or those that are socially and economically disadvantaged. The majority is that at least 51% ownership is by women, vets, or socially and economically disadvantaged individuals. There have been a number of questions that have come out about people trying to restructure their ownership so that they would fall into this first priority group. Don't bother. The ownership is applicable as of March 13th of this year. You can't change your ownership structure prior to applying at this point. That time, that there isn't time at this point to make that change. So it will be ownership as of that March 13th date. So trying to make a change at this point won't work. Again, it's a total of at least 51% owned. So if you have a business that is owned by 5 people, 3 of which are women, they're going to fall into that majority owned. If there's 5 owners and only 2 are women and the rest don't fall into any of the other categories, then they're not going to fall into this first priority group. So it does have to be a majority owned. There have been some questions. What does socially and economically disadvantaged individuals mean? Specifically per the SBA, it means those who have been subjected to racial or ethnic prejudice or cultural bias, and that the economically disadvantaged piece means that they haven't had access to capital or credit in the same way that others that do have access to that have had it. So you'll want to think about what, the SBA does have specific categories for socially and economically disadvantaged. So in their guide, they have more detail on what that means. Once that 3rd week is over, so day 22 through the end of the program, again, all applications will continue to be accepted and funding will be provided on a first come, first served basis. So it's important to note that even though that first 3 weeks of funding will only go out to that majority owned, that first priority group, all applications will be accepted as of day 1. So that funding provided on a first come, first served basis, if I'm the first application into the portal, but I don't have majority ownership of more than 51% based on that priority group, it should be that as of day 22, my application is going to be the first one in line. So make sure that if you intend to apply for this program, you're getting your application in as soon as possible. It just means that you may not receive funding or notification of funding for about 3 weeks after the portal is open. Other important notes to keep in mind, we've talked about double dipping before. If you've joined us on any of our other webinars, double dipping is a term that we're using to essentially say you can't use funds to cover expenses that are already covered by other money that you've received. So if you've gotten a PPP loan, if you've gotten an EIDL advance, or if you've taken the employee retention credit or any FFCRA credits or work opportunity credits, you can't use RRF funds to cover those expenses that are already covered by one of those either lending programs or grant programs or credits. So you just want to make sure that you're being careful, that you're not asking for too much money. If you've got more money than expenses that you have, you may be crossing over into some of this eligibility issue when it comes to double dipping. Obviously with RRF, you have a pretty substantial amount of time to use the funds. So you'll be able to use it over a period that extends well beyond some of these other lending programs or credit opportunities. So you shouldn't have too much of an issue. And again, RRF funds can be used for a pretty substantial amount of your normal and operating costs, most of them. So you shouldn't have too many issues with this double dipping, but just wanted to make sure everybody understands that. And just another note that you will need to provide information for all owners of 20% or more on the application. So if you've got an owner that's 20% and they're not comfortable with their information being put on this application, you might want to be talking to them about it now, because any owners of 20% or more will need to have their information listed. It's typically going to be a tax ID number, their name, potentially address. So you're going to just want to make sure that all of your owners are aware that this information will need to be provided. And with that, I've got a link to resources. So make sure that you're keeping an eye on our COVID-19 Resource Center. We try to send out emails about blog postings and events. So if you aren't signed up for any of our on any of our email lists, make sure that you visit our webpage and do that. And then I've got links to both the information landing page, where you can find out where you can review the program guide and also the draft application. And then I've also included a link to the portal landing page, which of course, again, is not open yet, but wanted to make sure that you have that address so you can link to it when the program does open. Just a note too, a reminder to visit that sba.gov website, sign up for their emails. They send emails as soon as information is available. And so you'll get the most up-to-date information directly from the SBA as well. So make sure you're signing up for those email lists. Melody, any questions that we need to go back and address?
Yes, I'm going to start with the general ones that apply to more. The question on submitting documentation for gross receipts, if you haven't filed your tax return, is a QuickBooks report of your financials sufficient?
It should be, yes. So they did specify that internally or externally prepared financial statements, it should just be that you need an income statement to document your gross receipts. What you want to make sure, again, is if you haven't filed your 2020 tax return yet, you want to make sure that your numbers are kind of finalized because they will be reconciling, if there is an audit or review procedure, the likelihood is that they would reconcile whatever you end up filing for your 2020 tax return back to what your application request was. So just make sure if you work with an accountant, talk to them, make sure your numbers look good. You don't have to have a 2020 return filed. You can use that internally prepared financial statement, but you just want to make sure that the numbers are good.
And for restaurants with multiple locations, do you file separate Schedule Cs? Do you combine the gross receipts or calculate each separately?
Great question. So it's really going to depend on whether you have a separate tax ID for each organization. So if you file 5 Schedule Cs and each one has their own employer identification number, you're going to file 5 different applications. Remember, you are going to have to report about affiliates. So on the application itself, each application, you're going to need to report those affiliated businesses. So on application 1, you're going to have to report affiliates 2 through 5, et cetera. So for each one, if you have a Schedule C and maybe you don't have an employer identification number for the business, maybe they're all reported under your Social Security number. In that case, you would file 1 application under your Social Security number, and you would combine all of the data from all 5 locations into 1 application. So it's all going to be about whether you have a separate employer identification number for each location.
Awesome. What about a bowling alley? If they serve food and meet the 33% test, are they eligible?
It's possible. So bowling alleys were not listed specifically on in the guide or on the SBA's webpage. However, it does say other eligible entities based on the criteria. So if I would say it is quite possible that you would be eligible. It's certainly worth your time to probably apply for it, since this application is really not too detailed and there aren't too many documents that you're going to have to compile. I would say it's probably worth it if you can prove that you meet that 33% test.
Great. This one is very specific. What if you closed last year, tried to sell, but decided to reopen this year under a different DBA name, but same ownership?
So if the same ownership, same tax ID, if I would say that was, you would be considered temporarily closed. And if you plan to reopen and you had incurred eligible expenses between February 15th and March 11th, I would say to me that you are eligible. The key is that you did not permanently close your doors. Even if you're operating under a different DBA, if you have the same employer identification number and same ownership, to me, that's a temporary closure. So I would think that you'll be eligible.
Here's another fairly specific one. What if it's a position of a cafeteria located within a corporate or government building, but operated by a restaurant owners or that contract with the corporation?
So again, it's going to go back to who is the owner of the business. As long as it's just a contract relationship with the state or local government owned business, and it's not that the business is owned by that government, that state or local government, you should be fine. It's going to go back to what type of entity is the owner of the business, what employer identification number is operating the business. If it's a privately owned business and it's just a contract work, you should absolutely be eligible.
Okay, 1 EIN, 2 locations. 1 location was open all of 2019 and 1 location was not. How do we calculate 2019 gross receipts?
So you're going to go ahead, if it's 1 EIN, you're basically going to look at calculations 1 and 2 kind of combined. So you're going to want to look at that second location that was not open for all of 2019, get an annualized gross receipts amount, and then combine it with your total 2019 gross receipts for the business that was open for the entirety of the year. So you're going to kind of do a combination of those first 2 calculations.
Okay, this one is, we own 2 restaurants that have separate federal IDs. However, they file only one 1120S tax return under the parent corporation. When they applied for PPP funds, they filed under 2 different federal IDs. What about the RRF? Should they file 1 or 2?
That's a good question. Since they have separate employer identification numbers, I would say that the likelihood is that you're going to need to file 2 separate grant applications. My question would be, how is it just all reported? Well, you probably have, I'm guessing you have separate books for each location, so you would be able to separate out. So you would likely need to include tax returns and potentially separately prepared financial statements for each one. You know, they can be internally prepared financial statements or bank statements that would supply the information for each location. The document, the guide for that's on the SBA's website is pretty specific in that it discusses if you have separate employer identification numbers, you would file separate applications for the grant. And I would relate it to being similar to your application for PPP, that you filed separate loan requests, and you would also file separate grant requests as well.
Great. And then a general question. Did you mention anything specific about co-ops and their eligibility?
I didn't mention anything specific about co-ops. The SBA's guidance doesn't have anything specific to co-ops. However, there isn't anything specific to say that they are not eligible. The requirements state that you need to be a C corporation, an S corporation, a partnership. Cooperatives typically file, although they file a different type of tax return, they file, you know, if you are organized as a cooperative at the federal level, you would file an 1120C, but you are filing as a C corporation. So you would be eligible. They just haven't provided specific guidance as to what line on the tax return, but there should be one that is similar to, I believe it was line 1C on the form 1120. There should be a comparable line on the 1120C tax return. So I would absolutely say that co-ops are eligible for this. Again, you have to meet some of those requirements, which I know many cooperative restaurants that do, but there was nothing to say that cooperatives were not eligible. So they absolutely should be.
Great. That is our questions. Thank you for all your answers and all the great information.
Absolutely. Thanks, Melody. Turn back over to Kristen.
Yes, thank you, Melody, and thank you, Kate, for all of your expertise today. As Kate mentioned, we keep our COVID-19 Resource Center on our website, the most up-to-date. So if you're not subscribed to that email list, please head over to our website and sign yourself up for that so you can get new information as it's released. Thanks, everybody, for joining us today, and have a great day.
Thank you.